Hello everyone and welcome back to Explain the Charts. Today, September 25th, 2025, we're taking an in-depth look at USDJPY, a pair currently at the crossroads of diverging central bank policies and significant economic data. The overarching narrative from the news suggests a theoretical downward pressure on USDJPY, as the Bank of Japan has hinted at further rate hikes, while the Federal Reserve is broadly expected to deliver 2 more rate cuts before the year's end. However, recent price action indicates a more complex picture, with the US dollar showing renewed strength. We've seen reports of dropping US jobless claims and an upward revision of second quarter GDP, providing tailwinds for the greenback. Conversely, Japan's manufacturing PMI has fallen, weakening the yen despite the hawkish BOJ rhetoric. Looking at the daily chart for USDJPY over the past year, we can observe a broadly choppy but ascending trend from late 2024 into early 2025. After a significant peak around July 2024, near 161, the pair experienced a sharp reversal, falling to the mid-140s by August 2024. Since then, USDJPY has been in a recovery phase, forming higher lows and challenging key resistance levels. Let's zoom into the more recent price action on the daily chart, focusing from early June 2025 to the latest candle. Here, we can clearly see the strong bullish momentum that has pushed USDJPY higher in the first 3 weeks of September 2025. Yesterday's candle, for September 24th, closed strongly at 148.778, near its high, with a significant 0.8% gain. This move is particularly important because it pushed the pair above the 200-day simple moving average, which several news sources identified around 148.51. The break above the 200-day SMA is a classic bullish technical trigger, suggesting a shift in market control towards buyers. The previous rejection around this level in early September can now be seen as a retest before this decisive breakout. This strength correlates directly with Federal Reserve Chair Powell's cautious remarks, which tempered expectations of aggressive rate cuts, thereby supporting the dollar. Immediately above our current price, we face significant resistance identified in the news between 148.65 and 150.00. including the September 2nd high at 148.94 and the July 16th peak at 149.18. A sustained move above this resistance corridor is crucial for the bulls to maintain control, with 150.00 serving as a major psychological barrier. Now let's switch to the 1-hour chart to observe the intraday dynamics around these levels, focusing on the period from September 8th to September 10th. Notice how the price initially flirted with the 148.30 level on September 8th, facing some resistance before a brief dip. The rally on September 9th showed increased volatility, yet the price struggled to maintain momentum above 147.50 for long. The hourly candles exhibit wicks indicating selling pressure whenever the price attempted to move higher, reflecting uncertainty despite the underlying daily bullish trend. The volume during these periods, though fluctuating, doesn't suggest overwhelming conviction from either side, contributing to the coiling quietly sentiment mentioned in some headlines. Switching to the 15-minute chart for September 24th, we can clearly see the battle that took place as USDJPY pushed through critical levels. Observe the candles around 12:40 Universal Time coordinated on September 24th, where the price surged from 148.549 to 148.689, breaking above the 200-day SMA at 148.51. This breakout was accompanied by decent volume, lending credibility to the move. Subsequent candles show consolidation and minor pullbacks, but strong defense of the newly established support, particularly around the 148.60 to 148.70 area. The continuous upward pressure throughout the day culminated in the close near 148.778, indicating that bulls maintained their advantage into the end of the trading day. This detailed view reinforces the news reports about the pair reaching new session highs and breaking key technical resistance. Reverting to the daily chart to recap, the short-term outlook for USDJPY appears cautiously bullish, primarily driven by the recent break above the 200-day SMA and renewed dollar strength. For bulls, the immediate target is a decisive breach and hold above the 149.20 to 150.00 resistance zone. A successful push past 150.00, especially towards the July/August 2024 highs near 150.91, would reinforce a strong bullish reversal from the recent lows. Reasons to be bullish include stronger than expected U.S. economic data, potential delays in BOJ rate hikes due to weak Japanese PMI, and the expectation of fewer Fed rate cuts than initially priced in. Conversely, a failure to break above 150.00 or a reversal below the 200-day SMA at 148.51 would signal renewed bearish pressure. Key short-term support levels to watch are the 200-day SMA at 148.51, then 148.00, and, critically, the 147.00 level, which corresponds to the monthly open. A break below 147.00 could open the door for a retest of 146.00 and even last week's low around 145.48. The longer-term bearish argument hinges on the fundamental divergence of central bank policies, with the BOJ eventually tightening and the Fed continuing its easing cycle. However, this requires sustained conviction from both central banks, which has been uneven as reflected in recent market movements. An important upcoming event is the U.S. core PCE report tomorrow, which could significantly influence the Federal Reserve's stance and, consequently, USDJPY's direction. In Japan, the Tokyo CPI on Friday is also pivotal, as an upside surprise could embolden the BOJ to act sooner. Traders should closely monitor these data releases and watch for signs of intervention if the pair approaches the 150.00 handle, where the risk of Japanese government intervention intensifies. The current sentiment seems to be a stalemate between fundamental divergence and short-term dollar strength, setting up for a big move upon clearer policy signals or economic data.